Did you know the majority of Americans don't have enough savings to cover an unexpected $1,000 expense? Financial emergencies can be devastating, so having an emergency fund is arguably the most important investment that you can make. In this video, we'll talk about the basics of emergency funds, explain why you need one, and provide some tips on how to start building your own. Watch until the end because I've saved the top tip for building an emergency fund for last. Let's jump in. First of all, what is an emergency fund? An emergency fund is a sum of money set aside specifically for unexpected expenses or emergencies. Some examples of a financial emergency include a sudden job loss, a medical emergency or unexpected medical bills, a natural disaster that damages your home, or an unexpected car repair. These types of emergencies can be financially devastating if you don't have enough liquid cash to fall back on. Without an emergency fund, you may be forced to borrow money from friends or family, take out a high-interest loan, or charge the expense on a credit card. All of these options can be stressful and costly in the long run. Think of an emergency fund as your financial safety net. Having one reduces financial stress and provides a sense of security and peace of mind. Now, you may be wondering whether you should pay off debt or build an emergency fund first. This is definitely a tough and personal decision, and you should strike a balance that you feel comfortable with. If you have a lot of debt and no savings, it's probably a good idea to start building your emergency fund while you continue to pay off the debt. However, keep in mind that high-interest debt is expensive, so it's important to strike a proper balance. So how much should you have in your emergency fund? You can start by saving a small amount and gradually increase it over time as you take care of other financial obligations, such as paying off high-interest debt. While the specific amount is a personal decision, a general rule of thumb to start with is enough to cover 1 month's worth of expenses and gradually increase it to 3, 6, or even 12 months worth of expenses, depending on your goals. A smaller emergency fund is riskier, while a large emergency fund is safer, but you should also weigh the opportunity costs of not using the money for other things, such as paying down high-interest debt or investing. With this in mind, set a specific goal that is reasonable for you. This will obviously vary from person to person. It may be $500, $1,000, or 1 month worth of expenses. Try not to set a goal that's so large that it feels unattainable. Once you have a goal in mind, it's time to decide where to store your emergency fund. It's generally recommended to keep your emergency fund in a safe and easily accessible place. Some key points to consider when choosing where to store your emergency fund include: number 1, safety. Look for a financial institution that is FDIC insured or backed by the NCUA, which means that your deposits are insured. Number 2, accessibility. Make sure that you can easily access your funds when you need them. This may mean, for example, choosing a savings account or CD with no early withdrawal penalties. Number 3, interest rates. While the interest rate on your emergency fund is not as important as the safety and accessibility of your funds, you may as well get a competitive rate on your money. Shop around, compare rates, and pick one that is competitive. Number 4, fees. Look for an account with low or no fees, since fees can quickly eat into your fund and erase any interest gained. Also, you may want to consider keeping your emergency fund somewhere other than your primary financial institution. For example, if you primarily bank with Chase, consider storing your emergency fund at other banks or credit unions. This will allow you to shop around for the highest rate and keep your emergency fund out of sight, which decreases the risk of impulsively spending it. Considering these factors, some popular places to store an emergency fund include high-yield savings accounts, rewards checking accounts, money market funds, and certificates of deposit. These types of accounts typically offer relatively low risk and easy access to your funds when you need them. It also may be a good idea to keep some physical cash on hand for emergencies that don't allow access to the above accounts. It's important to note that an emergency fund should not be used for long-term savings or investments. It should only be used for unexpected expenses or financial emergencies that require immediate access to your cash. For this reason, it's ideal to have a completely separate account for your emergency fund. Once you've decided where to keep your emergency fund, it's time to start saving. The best way to build your emergency fund is to set aside a certain amount of money each month. This can be as little as $5 to $10 or as much as you can afford. What's more important than the amount is that you're consistent, which leads to the top tip for building your emergency fund, which is to automate your savings. To ensure consistency, you should set up automatic transfers from your checking account to your emergency fund account. Ideally, the transfer should happen as soon as possible after you receive your paycheck, or even better, you could split your paycheck so some of your income goes directly into your emergency fund account. So that's it. Let us know in the comments about a time you wish you had an emergency fund, and be sure to like and subscribe for more videos.